understanding a cap rate can feel like cracking the Morse code for real estate investing, but it's actually pretty easy once you understand it. And today I'm going to explain it in easy to understand format, even if you're just beginning. Hi, I'm Renee Nelson. I'm a CCIM and the proud owner of PacWest Commercial Real Estate, and I'm here to walk you through how to calculate a cap rate. So let's say you know someone and they want to sell a property and they say the property generates $50,000 in annual income and I want a 5% cap rate. That's going to be pretty easy to calculate what the value of the property should be, because with calculating a cap rate, you only need three numbers. You need to know what the net operating income is of the property. You need to know what the cap rate is, and or to solve that, then that's going to give you the value. Or vice versa, if someone says, hey, I want $1 million for my property and it's generating a 5% cap rate, you can calculate pretty quickly how much the property is generating in net operating income. So let me give you an example. Let's say a property is generating $50,000 in annual income, net operating income, and the market is transacting or going cap rates are 5%. In that situation, what you would do is you'd take $50,000 and divide it by 0.05, 5%, and that would equate to $1 million. Now, same property, but we're going to use a 5.5% cap rate. So you take $50,000 for net operating income and you divide it by 0.055. That is going to give you $909,000. And the reason that it's good to know that easy math formula is it's pretty easy to calculate net operating income. I can actually do it now on the back of a cocktail napkin or an envelope. So if I meet someone at a party and they say, hey, what do you think my property is worth? I literally can take out my iPhone with my calculator in it, and with a pen, I can pretty quickly calculate and give them a ballpark knowing what going cap rates are. So let's say you know that somebody wants to sell a property at $1 million and they've told you that they think it's worth a 5 cap. What that's going to do is now you got to figure out what the net operating income is. And the reason that's important is that is going to tell you what that property is going to generate in net operating income in that point of time. So a net operating income is just a snapshot in time, and so is the cap rate. Cap rates change and vary based on location, city, area, as well as risk. Property type. So you might see a lower cap rate for a stable property like an apartment complex, but you might see a much higher cap rate for, say, an industrial warehouse or a vacant office building. So if a property is worth $1 million, you just take the 5% cap rate or whatever the going cap rate is and multiply it. So you take 1 million times 0.05, and that gets you $50,000 in net operating income. So if it's a 6 cap, now let's say we're moving up the risk threshold. So a 5% cap rate is pretty stable. That shows you that the property is probably filled with tenants, it's generating good net operating income, and it's probably a pretty safe investment. And in that situation, we're going to probably use a 5 to a 5.5% cap rate. So again, if it's worth $1 million and we're using a 5% cap rate, that means the property generates $50,000 in annual income. But let's say now we're looking at a mixed-use building. Some of it's retail and some of it has tenants up above it, or it's office, half of it's office, and some of it's got a little retail component. That may trade or sell more at a 6% cap rate. So in that situation, you take $1 million times 0.06, and that shows you that the property generates $60,000. Now, what a higher cap rate means is you're taking more risk. You're buying something with a higher cap rate. So in relation or return for you taking a higher risk and having a higher cap rate, you should get paid more as an investor. So that's why you would earn $60,000. Now let's use the same $1 million, but say it's on a vacant warehouse. You don't have a business that you're going to move into it. You're just buying an investment, and then you have to go out and fill it with a tenant. So now you've got $1 million building and it's selling for an 8% cap rate. So that's going to generate you $80,000. Now, part of the dilemma there is you're going to have vacancy and you're going to have to fill the property. So not everybody has an appetite for high cap rates because it's risky. Often I'll have out-of-town investors call me and say, hey, Renee, I'm looking to buy in your market and I want something at a 10 cap. I can tell that they're not familiar with cap rates in our area, and especially if they're looking for multifamily, because we just don't have a lot of property that's in distress and despair that would reach that cap rate. And I always caution them that we need to have kind of a lesson 101 in cap rates before I start sending them inventory, because I'm never going to hit their mark of expectation of a 10% cap rate. No matter how many times they pester me and ask me to send them a list, at the end of the day, a 10 cap is not really common in our market. Again, unless it's a total train wreck and it's a really rough property, you'll see a higher cap rate, but there's some pitfalls to that property. Either it has deferred maintenance, maybe it's not financeable, so you'd have to pay all cash, or maybe it's 100% vacant and it's not generating any net operating income. In a situation, if a building is vacant, what we do to calculate the net operating income is I search the market to see what the market rent would be, and then I build a pro forma using proposed market rents, a 5% vacancy factor, and then we build in the operating expenses. But part of the problem is investors love to buy stuff at high cap rates, but lenders do not like to loan at that. So if you're going to look at something with a high cap rate, you will probably need to be prepared to pay all cash or finance it with a hard money loan for, say, 6 months to 12 months while you're stabilizing the property. So you may buy something with a high cap rate, get it stabilized where you cure the deferred maintenance or you increase the rents or get it occupied with tenants. And then at the end of 6 or 12 months, then you could go and refinance and put on a normal commercial loan. I'm going to give you 2 examples, real life examples of properties that I have just recently sold and how the cap rate changes based off of factors related to the property. So the first one is a 17-unit apartment complex that I sold that was within walking distance to the U of O. And originally, I calculated the net operating income to be $144,900. So I applied a cap rate of 5.32%, which equated to $2,725,000. And again, to factor that, you take the net operating income divided by the 0.0532, and that tells you what the list price is. So I listed the property at $2,725,000. Before I even put it on the market, I had a signed listing agreement, but I reached out to several parties that I knew would be interested, and someone did offer on the property before we took it to the open market. It happened so quick after I had the listing agreement signed that we did still put it out on the open market, but we went ahead and accepted the offer because it was pretty close to the actual list price. During the due diligence, the buyer found several items of deferred maintenance. Now, some of these buildings were built in 1948, and when you've got 17 tenants living in property, I can guarantee you that there's going to be a bathroom floor that's going to have dry rot. There's going to be some plumbing or electrical that needs to be updated. So we negotiated between the buyer and the seller, and the final sales price wound up being $2,600,000. So now to equate that to a cap rate, we know that the net operating income was $144,900. We're going to divide that by the sales price at $2,600,000, which was the final price that it closed at, and the cap rate on that was 5.57. So the cap rate went up and the price went down because we negotiated on the price to take into account the deferred maintenance, and the cap rate went up because the buyer was saying, Mr. Seller, I'm willing to accept this property if you'll give me a slight discount in price. I'll cure the deferred maintenance after closing. And so in comparison for that, or in relation to that, I want a slight adjustment in price to compensate me. So the buyer's cap rate went from 5.32 up to 5.57. Now you may be saying, well, wait a second. Why is this buyer willing to buy something at a 5.5 cap rate? It is walkable to the U of O, to the University of Oregon, but you may be saying, wait a second, why is a buyer willing to buy something at a 5.5 cap rate when maybe he could buy something newer that didn't have deferred maintenance, or maybe he could get something with a better rate of return? In this situation, he bought this because he plans to actually tear down some of these buildings over the next couple of years and actually construct nice new 2-3-story buildings and do new construction. So for him, it was important to secure the property, buy it and take it off the market before anybody else made a competing offer, because he has a vision of where he's going to take it. And in the meantime, he's earning $144,900 on his money this year. So again, a cap rate is a snapshot at that moment, and in that moment of time. Next year, his cap rate will change because in 12 months, he'll be able to raise rents when he leases up for the new school year. Okay, one more example. I just sold a 12-unit apartment complex, and originally when I calculated the net operating income, I used the seller's insurance information that they had been given. But again, in some of my other videos, I've shared how insurance in the commercial real estate world has become the Wild West. On that 17 unit that I just shared with you, in that particular scenario, that seller's insurance had been around $7,900 on an annual basis. When the buyer got ready to close on that transaction, his annual insurance premium was $20,000. So that's like 185% increase in insurance premiums. And unfortunately, that is happening right now. Right now, we are experiencing this where insurance companies are saying, I'm sorry, we won't loan on that property due to the age, due to the condition. There's been several national companies like State Farm, Allstate, American Family. They're not even loaning on a lot of multifamily right now because they've suffered such big losses on a national level due to flood, due to hurricanes, wildfires in California. So the insurance has become kind of the Wild West in the underwriting process. And now I'm building my pro formas super aggressive on insurance because I don't want sticker shock for the buyer if he thinks the annual premium should be $7,900 because that's what it's been for the seller for the last 3 years. But now all of a sudden he hears that it's $20,000. That's going to make a pretty big impact in his net operating income. So I'm keeping a compilation of insurance, and we're tracking that. And obviously it goes by age and condition of the building on what the insurance will be, but we are definitely tracking that, and that gets factored into the net operating income. So in this 12-unit scenario, they're mainly one-bedroom units. They were built in the late 60s, early 70s, and I factored in $5,000 for the insurance, again, because that had been the 3-year trend looking at the seller's tax returns. When we got ready to close, the buyer's insurance was higher, and so that made an impact of about $5,000 in the net operating income. So in this situation, I figured that the net operating income would be $75,000, but it actually was closer to $70,000. So when I priced the property originally for the listing, I factored in all the expenses and we factored in a 5% cap rate. So in that situation, we take $75,000 and we divide it by 0.05, and that tells us that the list price should be $1,500,000. But during the inspection process, a couple of things came up that the seller needed to cure, and also with the higher insurance premiums that reduced the net operating income. So in that situation, we wound up closing that transaction at $1,425,000. And so the cap rate on that was closer to 5%. Because when I originally started, I was going to use a 5% cap rate. So again, I looked and analyzed 3 years of my seller's tax returns to create the pro forma. I looked at their current rent roll from their property manager. I factored in a 5% vacancy factor, and then I deducted all of the operating expenses for what is common in the market. And I looked at the seller's tax returns, and we factored in the insurance premium off of the seller's tax return. But then when we got ready to close, because we're in this changing dynamic right now with insurance, the net operating income was reduced. And so that also changed the cap rate. So while I felt like I was pricing the property at a 5 cap initially, I was actually pricing it at a 4.67 cap rate when you factor in the additional insurance. Now, the buyer was willing to do that because he is going to go in and renovate the units. They're primarily studios and 1-bedrooms. He's going to go in on turnover and renovate these units and put in new kitchens, new flooring, new paint, new countertops, new bathrooms, etc. And he'll be able to increase his rents because this property is rented below market, and also because he's going to be able to go in, renovate these, and then on release up, he'll be able to go up to market rent. So cap rates, as you can see, vary. They're not stagnant, and you can't use one cap rate across the board for property. You really need to deal with an expert and have someone walk you through a cap rate and analyze a cap rate also. Often I see with commercial real estate brokers, sometimes they'll go light on certain expenses, or they'll leave expenses out of pro forma because they are trying to show and bolster the net operating income as high as possible. But that does not bode well for a buyer, because when you close on the property and you go to operate that property, it may not generate as much net operating income as what was originally portrayed. So it's really your job as a buyer to know what you're doing and to work with a broker that is going to walk you through that and help you understand the numbers and be able to analyze the property and look and see if the property is really going to perform that way. I hope this was helpful. I hope revealing that the cap rate, as you can see, when you peek behind the green curtain, cap rates really are easy to understand if you understand how they're compiled. So to recap, you start with gross rents, deduct out vacancy, and then from there you've got your rents, take out your operating expenses. That's going to give you net operating income, and then you divide it by the sales price, and that's going to give you a cap rate. I hope this was helpful. Thanks for watching. Oh, and don't forget, click the subscribe button so you can be notified when we post our next video.